Can I ask you a question? Who trades your portfolio? Not the name at the top of your statement or your broker-dealer. Who's actually trading your account? Have you met them? Do they ever call you? In what are you invested? Stocks, bonds, ETFs, commodities? Do you know what you're invested in and why? When is your account invested? Is it some random corporate mandated trading schedule or a rigorously tested and timed trading plan? Where are you invested? We currently have positions in Tokyo, Shanghai, Paris, Amsterdam, and the New York markets. Our clients have unique worldwide opportunities. How do you track performance? I know managers have downturns. I've certainly had mine. How is risk controlled in your portfolio? Open-ended, or is it well-defined? Do you know the answers to these questions? If you don't, you should. If you want to know, we can help. My life's passion is to educate, edify, and even entertain our clients and YouTube viewers with essential knowledge to understand their investment choices. We believe an investment leader is one who first knows the way and then goes the way and then shows the way. At CB3 Financial, we don't just manage your assets, we become one of them. Good evening, everyone. We are live from Chicago. Today is Thursday, September 21st. I'm Charles Brown, Portfolio Manager with CB3 Financial. We are so glad you are with us tonight. If this is your first time on CB3 Live, we'd ask that you check the box to subscribe to our channel and then click the little box where the bell is so you can be updated whenever we go live, like now, upload a pre-recorded video like we did last night. Okay, you can also follow me on Twitter, which is now X. You can follow me on Facebook, which is now Meta. And you can follow me on LinkedIn, which I think is still on LinkedIn. But CB3 Live audience on YouTube, I'm going to ask you to pause just for a second because tonight is a super special night. We have a live audience for the first time in 3.5 years. Many of you, let's have a hand for you guys. Let's have a hand. I see faces that I have seen since 2008. We have done this for 15 years. We've got a lot more to go. Okay? So let's get started. Everybody here okay? Got enough refreshments? All right, we're trying to get our clicker working here. So the purpose of these programs is threefold. We educate, we edify, we entertain. Edify we use a phrase to instruct or intellectually improve someone's KB. KB is just, well, I guess it's geek speak for knowledge base. Okay, we're trying to bring that to you. And the way we've done it for the last 3.5 years, we stopped doing these, those of you that remember, in January 2020, and we went to the YouTube format, and we started using this matrix of segments. So the way this works is tonight, few times a year, I talk about the why. You already saw the video that talks about who, what, when, where, how. Now we're going to talk about the why of CB3 and why we do what we do. And then the next 10 segments are data inputs for me to make the trading decisions for your portfolios. And if you're not a client, that's fine. You can just listen to how a portfolio manager thinks, which is a good thing to do. All right. And then the last section, I'm going to go into significant detail about our investment methodology. It has evolved over the years. It's in a really good place right now, and I want to share that with you. So why? Why CB3? So I began my professional investing experience trading commodities at the Chicago Mercantile Exchange. Many people in this industry either started in insurance or selling mutual funds, might have an MBA. All of those are great paths to get there. It's just not what I did. I began this as a trader working at what is now the largest futures exchange in the world. I have a specific trading methodology and detailed risk management strategy that is foundational to my approach. Our clients have always traded exactly the same programs that Alice and I trade. Now, this is not Bernie Madoff. We don't put all the money in one pot. That's what got him into trouble. Everyone has segregated accounts. And not everyone has the same weighting. We have 3 investment programs. I may be more or less aggressive than my clients, but we're all in the same 3 programs. And the advantage of that is I know what's in your program, and I'm feeling the same pain you're feeling on a day like today. And for those of you that have come to these for years, how many times have I done a fireside chat? This is not for the CB3 Live audience. This is for our local audience here, where the market just pukes the day of my show. But I am not concerned because we have risk management strategies in place, and we're going to talk about those. Alice and I have about 80% of our net worth in our programs. That's been pretty constant over the 20 years that we've been doing this. So the CMT, after my name there, stands for Chartered Market Technician. As of July 2023, there are 190,000 CFA, those are the analysts, CPAs, 665,000, 203,000 certified financial planners, and they're all admirable professions. The difference is that they get to do their work not in real time. Then they meet their clients with their work. Ours is done in real time in front of the screen. There are only 4,700 chartered market technicians, and in years like 2008, you'll see them in straitjackets in the local psych ward because we have to make decisions in real time on behalf of our client, and we choose this because we love doing what we do. When I speak to you, our investors, and if you're not an investor, that's fine. Some of you invest through a different broker-dealer. Some of you are my direct clients. Some of you have just been watching around the country on YouTube Live. But I remember things about you. I do my best to. I know you on a personal level, and many of you I know at a friendship. Okay? I don't treat you as a number or some expected value on my annual P&L statement. We're not really kind of a corporate vibe here at CB3 Financial. We're a boutique firm. And when one of our investors wants to contribute more money, I speak directly to them, and I thank them. I never take it for granted. There's a collaborative field, not a corporate one. We walk through topics like the timing of the investment. Sometimes you want a dollar cost average. Sometimes you just want to put it all in. It depends. We talk through that. It's customized for each individual client. All of these things matter to me, and I think they should matter to you. All right, still having some problems with our Twitter, but we'll get through this. Handing money to someone is an intimate transaction. And we at CB do not take this lightly. We treat it with respect. We handle it as if it were our own, and there is no other way. For 20 years, our positioning statement reflects the sincere commitment that Alice and I make to every client. Many of you in the room, many of you online right now. At CB3 Financial, we don't just manage your assets. We become one of them. So we're going to walk through these segments. If my clicker is fighting me tonight, guys, and I'm sorry. There must be some ultraviolet lights in the room here. These next 10 segments, a total of 12. We did the why. We're going to look at the investment methodology, but these 10 segments are the data points that I use to make decisions on your account. The first thing we do is look at the current month. I'm feeling a little audio coming in now. We okay? All right. So it will come to no surprise to you that September from 1950 to today is the worst trading month of the year. Today was just a perfect example of it. All right. Not sure why. Maybe it's because back to school. Maybe it's because we're not yet in front of the holidays. It's the end of the third quarter. But over time, September has historically been the worst month for performance and very volatile. So the S&P was trading at a high multiple. We don't have to dig into this too much, but 19 times 4, that's now dropped to 17.6 just this month. So as stocks go down in price, their PE multiple drops and they become more attractive. So at some point, the selling stops. We all know that. And they come back in. But these are a list of the worst Septembers. Now, these are not for an annual basis. Look at 1931, 30% in 1 month. So why am I showing you this? Because recency bias hurts investors, meaning they start thinking with myopic views, this is the way it's always going to be. And I'm here to tell you it's not. So September, if you were to only trade on these individual days, these 7 days on the screen, and we're in day number 2 right now, if you only had money in the market on September 21st, you'd be down 60% in the 73 years since 1950. Look how bad these days are. But we get out of them, and that's why you can't come in and out of the market hoping to perfectly time it. You just can't do it. And the NASDAQ and the Russell are no better. So why am I spending the time on this? Don't panic. Don't let months like September, and frankly, August is usually pretty bad too, because coming up is November and December, which are the strongest 2 months of the year. This is the most important chart in the whole program. There are other charts that are important, but this is the most important one. This is 100 years of the S&P 500. You may not be able to see everything on here, but you can see the red blobs, right? Those are what is known as secular bear markets. We have secular, and then we have cyclical. Watch my hands. Secular, cyclical. So cyclical means one business cycle. Secular means multiple business cycles. There have only been 3 in 100 years. When you are in the middle of a downturn like 2022, like 2020, like 2008, it feels like this is the way it's going to be forever. But this is the reality. This is why I try to discourage people from watching the corporate media, because they want the eyeballs. They want to show you the bad. This is the truth. And in the last 2 bear markets, which you would have thought would have been negative, actually, they were both positive. They were just positive by a tiny amount. So if you look at it, let's see, I don't know whether we have a red dot on this, but I'm going to actually walk over here. This is 1987. Remember the market crash in 1987? And it felt horrible at the time, like it was never going to come back. Well, what happened? I want to keep drilling this in about the myopic view of the market. Over the long term, the direction is solidly up. Now, you will say, and it's even if I don't hear it come out of your mouths, but I'm X, 60, 65, 72, and I don't have 100 years for it to come back. That is a different issue. That's a money management issue. We're going to get to that in the last section. All right. This is the true history of the market. And this is why you have to believe long-term that we're going to be fine. All right. So this is a slide that I've been showing for CB3LIVE audience. And here we are again at the end of this quarter. You guys on CB3LIVE, you remember that 73% is the normal number that seems to be where the number of S&P companies reporting their earnings come in. So 73% beat their forecast. Well, with everything that's happening, we're at 79% with only 1 stock remaining to be reported. You can see the 1 up on the screen. Consumer discretionary, one of the 3 most aggressive sectors, at 85%. Healthcare at 91%. Technology at 91%. Communication services at 85%. The data on the screen is telling us, guys, we're still making money. We're exceeding the forecast we gave you. We're going to be fine. That's what the S&P earnings are telling you. Turn off the TV. I understand markets go off. Look today, NASDAQ down 300 points into the close. A lot of that is panic selling, right? So next segment. This has become my most controversial segment, and that's because it's U.S. policy, but I'm going to draw a strong distinction between politics and policy. So everything begins with politics. You use politics to get to policy. As much as possible, I try to avoid politics. I find it distasteful. I'm wearied of it. When I came back to Illinois, I registered as an independent. Sorry for those of you on the right that are shrieking now that have known me for 25 years, but I'm a registered independent. Politics leads to policy. Policy has personal impact, and a personal impact affects our portfolios. Those are the 4 Ps. So I just want to show you, normally we would expand more in this section, but I'm going to just show the dichotomy here. You would think that, many people tell me, so which of the last 3 presidents has had the best growth in the stock market during their terms? And people immediately say Donald Trump. Actually, no. He's third. Okay, Barack Obama's first term, and then his second term, and then Trump, and Biden is down there in green, largely because of the 2022 pullback, but also because of inflation. So the purpose of this segment is to show you that just because a Republican or just because a Democrat is in the White House does not mean the market's going to behave in a certain way. Turn off the TV, all right? There are good things and bad things that happen during certain terms. So this is Bush, Obama, Trump, and Biden. You can see that the market went up. The average real wealth was stronger during Bush's term. It got stronger in Obama. It got much stronger during Trump, but now it's turned down for Biden. Does that mean that Biden's responsible for that? You have to make up your decision on that. That's politics, and I don't talk about that in this program. Okay? That's just the numbers. So what about inflation? Well, clearly inflation has gone crazy during the Biden administration. But it's not just here in America. It's across the world. And in fact, we're doing better than the rest of the world, which we'll get to in the inflation section. Labor force participation rate is stronger during the Biden administration than it was in the Trump administration. Tell me why. Nobody knows. More people are working percentage-wise than they were working during the Trump administration in the Biden. What about the Fed funds rate? Well, we're going to get this, guys. Oh, man. All right, all right. Fed fund. Why is the Fed fund rate higher? Because inflation's higher, because the Fed is trying as hard as they can to quell inflation. So that's an X for Biden and a yay for Trump. However, what about annual median sales of your homes? Much higher during Biden than they were during Trump. So I don't need to belabor this, but the point is, don't get caught up in the politics. Look at the actual data. I might have political opinions, but when I'm making decisions for your portfolio using this data point, I got to look at what's happening in the data point. And this to me says the consumer is strong. When we talk about housing, we have a whole segment on housing coming up. Okay, next, the Fed. See a show of hands, people like the Fed. I might decide which joke to use here. Oh, so nobody. Okay, so we're going to use a lot of acronyms tonight. The first one is FED. I know what you think it stands for. It actually stands for Fabulously Educated Dummies. And I say that because everyone there has multiple PhDs that are on the Fed, but they don't have real world experience. I don't believe they do. They haven't traded, they haven't managed money, they're theorists. And so they are slow to catch up with what is really happening. Finally, because they so aggressively raised rates, we are seeing the forecast for inflation coming down. All you need to pay attention to is the blue line and the yellow line. All right? Their forecast for the Fed funds rate is out to 2%. By the time we get to 26, that's a long time. And the reason it's that far in the future is because 75 basis points really hurt us. And that is affecting how we make decisions for people, because it affects how consumers spend. Okay? Yesterday, no rate hike. Great, right? I think we need to be done. I don't think there's anything that warrants more rate hikes from the Fed. But don't get your hopes up for cuts. We could go most, if not all of next year, right where we are, which is currently 5.25, 5.5. All right? There's their target. Now look carefully at this stair step. I want you to understand this. Look at 2005 underneath Ben Bernanke, okay, in his term. You see the little stair steps? Those are 25 basis point increases. All right, 2015, that's Powell. But now look at 2022. Those 75 basis point jumps, they spook the market. They make consumers tighten down and say, if that's what's going to happen, my house is going to cost more if I'm on a variable rate. My car is going to cost more if I want to go buy and replace it. And when consumers get spooked, it's bad for the economy. Why? Because as you know, GDP, which is gross domestic product, only has three components, CB3LIVE people. The consumer, the government spending, and corporate spending. And 2/3 of that, more than 2/3 of that, is the consumer. And if interest rates are high, you're going to discourage the consumer. And if the consumer is discouraged and they don't buy widgets, then that affects businesses. You'll see this more as we go through the following segments. But this is all part of the decision process in how we do things. So the Fed's job, they have two mandates. The first is inflation, which is what we're going to cover right now. And the second is optimal employment, which we'll cover 2 more segments from now. That's the only reason the Fed exists, other than to have spitballs thrown at them. Keep inflation at 2% or close to it, and keep the unemployment rate around 3 to 3.5%. They're pretty close on the unemployment rate, not so good on the inflation rate. So inflation, excluding food and energy, nicely dropped to 4.3 in August from 4.7 in July. That's a good number. I'm encouraged by that. I can make decisions in my screening, and we're going to talk about screening in the last module, when I see that kind of data. If month over month inflation stabilizes around 3%, what's the Fed's target? Who's listening? 2, right? But if it stabilizes at 3, they're going to stop the hiking, because they're just going to let it gently glide down to 2. They're not going to continue to raise rates when we get to 3. We're not at 3, not even close, as you just saw. So if you look at charts like this, you can see the gauge. You want to see this going down. You want to see stock prices going up. This is like the difference between baseball and golf. High score in baseball and football, low score in golf. Low score in inflation is what we want. These lines going down. And that's what's happening. And the Fed sees it, and they know it. And yet they don't want inflation to linger. Still, that last percent from 3 to 2, you're going to see that being talked about most of 2024. How do we get that last percent down there? Here are the risks in inflation. Healthcare, what a surprise. All of us baby boomers, most of us, I don't know if we've got some exceptions here, but most of us are in that range. And we need more healthcare than we've ever needed it, right? Because we're older. 6.5% is the target inflation rate for healthcare service, and that's a concern, unless you're investing in healthcare companies, which if you are a client and you have CG, and you know, you'll see those coming into your portfolio because of this, because they benefit. There's really no reason to ever shrink from what is going on in the market. You just have to find what the opportunity is, and you find it by doing this kind of analysis. All right. The other big concern is, as you would guess, energy. I'm going to get this sooner or later. The 4 key components: gasoline, crude oil, diesel, jet fuel. They're rising. Not what we want to see. There is not a single consumer that wants to pay more for an airplane ticket because the airline is paying more for diesel. They don't want to do that. There's not a single person. I paid $5.45 to fill up my car today, a gallon. I don't want to do that. Because for many people, and me to some extent, that's money that could be used for discretionary spending, which is what drives the stock market. When it's going into energy, it's not really helping build the market. All right? And yet, look at this chart. Just look at the lines, the colors. Black, that's us, coming down. How'd you like to be in the Eurozone? Still rising, just glued at 6%. The UK, glued at 7%. So as much as we complain about Jay Powell, and I do, I wouldn't want to be them. All right? So that's the inflation story. If this continues to get out of hand, it leads into recession. How many times I get asked about recession? I don't know, Alice, you've got questions online. We've got people that are dialing in with questions. And if I get a recession question, I'll take it. But there's only 2 slides in this, guys, and it's pretty simple. This is the Reuters poll that shows the probability. A lot of us in the industry follow this. What are the lines doing? going down. When you're talking about the probability of a recession, you want the lines to go down. And we're seeing that. And this is a full year and a half graph, all the way back to April of 2022. And it peaked there for a while at 60%, and now it's down 45, 40%. I track this because as people begin to think the recession's not going to happen, what are they going to do? They're going to spend. They're going to put money on their credit cards. I'm not here to advise whether you should be living that way, deficit lifestyle. But if they're spending money, I need to put your money where people are spending money. And it has to be done in a very systematic way and a non-hodgepodge way. Make sense? So what happens when a recession hits? Unemployment will significantly rise. Do we have an unemployment problem in America? No. But those of you that have been here since 2008, remember when we definitely had an unemployment problem, well over 10%. Okay, so until unemployment rises, we can't have a recession. We just can't. There's not going to be a recession with 3.5% unemployment. If it takes up to 5.5 or 6, I'll get back to you. That's why we do these programs every month. By the way, we're doing these going forward many years. I'll get into this a little bit, but 3 times a year. So September, January, and May, just like we did years ago. And then in the off months, we'll be live on CB3 Live to our audience there. So reduced consumer spending would make sense. If you're spending less money because you don't have a job, then there's less consumer spending. And we already know that the consumer is 2/3 of the US economy. And then reduce business investment because companies aren't going to make widgets and put them in a warehouse. They're repurposing warehouses and business, commercial space anyway because of COVID, right? So it's a trifecta of problems, but it's in green because it's where we are. We are in the US at this time, and we are not anywhere close to this scenario. Turn off the corporate media. When we're close, I'll tell you. Watch the show. Watch our updates. Watch the holdings change in your portfolios. Okay? So the U.S. housing market, I mentioned that the consumer is the #1 driver of GDP in America, and actually mostly around the world too. Consumer spending. Trillions of dollars a year in the U.S. So why is the housing market my target? Because homes are the highest priced discretionary item. What's next? Cars. And after that, it's a lot of other things. Vacations, whatever. So how is the housing market? Well, unlike stocks, 2/3 of Americans own their home. This was more like 3/4 of Americans back in 2007. How many of you remember what happened in 2007? Everybody that could fog a mirror, and maybe some that couldn't, got a home. I would like to see this get back to 3/4, because if 3/4 of Americans are being able to afford a home, that's a healthier economy than what we have right now. I'm seeing the fall in home prices getting nearly at the end. And I'll tell you the way I know from personal experience. We had a price war when we left Nashville. We had a price war when we bought in Glen Ellen. I have a client that is moving to Michigan. They had 3 bids on their home. So for the right property, we still have plenty of demand. And what's astounding, and I'll get to this in the last slide, is we still have high interest rates. I mean, pretty high interest rates. So when you're mining for gold, and I put the red line here just for you, right? So you would think this headline, I love these headlines, U.S. housing starts hit a 3-year low. It's terrible. But what they don't tell you, and I'm superimposing the purple line, building permits went up. You see the red arrow there? You have to search for this. You have to search to it and come to your own conclusions. Because if I trade based on what I see in the media, it's a disaster for you guys and for us. So I like the fact that I'm seeing permits surge, and I'm going to find the right time to go in with builders, home builders, D.H. Horton, et cetera, those kind of companies. So homeowners don't want to sell. That's why builders are staying busy. Why don't they want to sell? Because when COVID hit, everybody became homebodies. We stopped taking showers. I'll speak for myself. I'm still getting back to trying to take 7 showers a week. I don't think that's probably not something should be. Excuse me, CB3 Live people, you didn't hear that. Edit that out, would you, Patrick? But lifestyles change is the point that I'm making. Remember, one of our 3 directives is entertain. So. And when they changed, people started investing in their homes. And they made them pretty nice. And it's like, this is really, you know what it's like to fix up a house and then you move and you sell it. And it's like, why don't we do this when we lived here? But now they're doing it. All right. And because of that, people are leaving college and going into the workforce. And it's astounding to me what some of these zillennials or whatever they are making when they get out of college. Again, because of the unemployment rate, which we'll get to in the next section. Do you know that there are 1.6 jobs available for every one person not working? What a great time to get out of college, especially if you're trained for jobs that are in demand. So as a result of all this, home equity as a percentage of personal income is above the highs seen 20 years ago. Now, I want to draw to your attention, this is 3 years after COVID. We have a war in the Middle East. We have total dysfunction in our government. We have all kinds of geopolitical problems right here in America and abroad. And yet, how are we seeing disposable income at the highs? Because people are getting smarter with their money, as hard as that is to believe. And they're still buying. I pointed to this in just a few slides ago. We're seeing the 30-year mortgage. You see it on the screen? 7.5. You see that tip at the bottom there? That's 2 5/8. That happened to be when we bought our house in Nashville. I had a 2 5/8 mortgage. For you who like decimals, that's 2.625. Do you have any idea how tough it was to close on that house and buy a house in Glen Ellen at 6 1/4? But the property taxes are more friendly in Illinois, though, right? Okay, so everybody's listening. That's great. 3,600 square foot home in Nashville, annual taxes $4,100. 3,600 square feet. Had to ask the realtor 3 times. But now it's even higher. But has this slowed down the home market? It has not. Why? Because the consumer is all powerful. They see everything that you and I see, but they want what they want, and they're finding out a way to get it. That's the resiliency that you see in a secular bull market. You saw my big chart. We've only had 3 secular bears in 100 years, 4 secular bulls. The average length is 20 years. The current secular bull market started on April 10th, 2013. That's when the high of the S&P broke out from that consolidation, if you think back to the red, excuse me. And since that time, there have been pullbacks, certainly during COVID, but it's not deterring the underlying spirit of Americans that are doing things like buying homes and not even flinching at 7.5% on a mortgage rate. As a portfolio manager, I have to pay attention to this because it gives me confidence to say they're not just going to tuck under the covers at the first little sign of a down 300-point day in the NASDAQ like today. All right? So the employment scenario, the most important data point, you probably heard the jobs report, it's also called non-farm payroll. It comes out on the first Friday, except on a rare case, but usually the first Friday of the month, unless it's, Good Friday, but regardless. The data that's in here are the number of people that are employed. Has the unemployment rate changed? What's the average work week? What's the percentage of the population that's working? For me, where I want to see a strong economy and find stocks that are catering to people that have money to do that, this data is crucial, and to many, many other portfolio managers as well. So the surprise for, and in September, where we are, we're looking at the August employment. And the first Friday of October, we'll look at the September unemployment, right? So the survey was for 170, not 170 jobs. This is in hundreds of thousands. But the actual number was 187. That's why that red bar is higher. There just continue to be surprises to the upside. Now, you might say, well, those lines are going down. That can't be good. Folks, they're going down while the fabulously educated dummies are raising interest rates every time they meet at 75 basis points. And the consumer is saying, we don't care. This is what we want. I'm not here to judge whether that's the right mindset. I am here to make trading decisions based on how the American consumer, which is the strongest economic force on the planet, how they are behaving. So you would think going down is bad, right? U.S. jobs report signals smooth downshift. It has to. It has to, because the Fed is crushing us. Now, if this were going straight down like it did in 2020, that would be bad, because that's how recessions happen. Did you know the shortest recession in history happened between March of 2020 and June of 2020? I mean, it was almost a joke. When they plot them on a screen, you have to kind of highlight it in purple or something because you can't see it. It's so thin. So the Fed is doing the right thing here. They didn't do it the right way, but they're doing what they need to do, which is slow the economy down, but still give it enough incentive for people to spend. And that's what's happening. I like this curve. It seems counterintuitive, but it's what we want to see, because we want to continue to invest in the way consumers are spending. U.S. employment level. So the Congressional Budget Office, they're pretty high authority on what's actually being done, what's being spent, what budgets are across the nation for companies. The dotted line is when COVID kicked in. And they saw this huge V. You've heard me talk about, you guys on CB3LIVE have heard me talk about V corrections all the time. This is a V correction, all right, in the SIBO, all right? And so they put this dot on there just figuring, well, we don't know what's going to happen because this has not happened in 100 some years. And look at the strength of the economy. So the actual employment level has overtaken the projection. Say what you will about the current administration, say what you will about the war, say what you will about so many things that are dysfunctional in America. I don't believe this data is lying. It's corroborated by the Labor Department and the Congressional Budget Office. I put sources on here so you know I'm not just making this stuff up. All right? That is good data. Moving through our indicators here, economic indicators. So this is sort of a miscellaneous catch-all category. If it's something that doesn't fit nicely into my other segments that I'm using as data points, then I am putting them here. And this is a real interesting one to me. So August retail sales expectations were higher. Isn't that great? But the only reason that they were higher is because people were spending more on gasoline. Now, I think that needs a big asterisk, because I'm glad you have the money to spend on gasoline, but who wants to do that? Have any of you, raise your hand if you've gone to the pump, seen it's $1 higher than it was the last time you were there, and you've gone, I just feel like I'm contributing to the economy. I feel really good about this. Zero. All right. It is a juxtaposition of data, is what I call them, where we have higher sales, but for the wrong reason. What was that song? You did it for the right thing, but it was for the wrong time. I forget that now. Keith knows music. He'll probably tell me what that song was. So this is the biggest if right now. Now, we can watch reruns on Netflix and Disney and Prime and all the other channels if there are no new TV shows, and it looks like there will be nothing now till Christmas. But if we don't have our cars, used car lots, all of a sudden got to be real hot places here. This has never happened where UAW has struck all three. They are really angry this time. And that's why I put in red. No matter what happens, no matter what this outcome is, Elon Musk is the winner. It's just true. Okay? We are not competitive enough, and this is now me opining. We are not competitive enough worldwide to give them everything that they want and still compete with Asian producers. And they're going to have to work this out. And that's the only opinion I'm going to opine. I'm going to invest where I see the opportunities. You saw in there where we invest. Those of you that are with me and traded Interactive Brokers know that you can have positions in China, you can have positions in Japan, the Netherlands, France, wherever I need to go. Got a segment coming up. We're going to talk about India. All right, so we go wherever in the world we need to go for the opportunity. But this is a big deal. So I will be issuing email updates. You guys are on the mailing list now as to when this moves forward. This is a reiteration of U.S. household net worth jumping to a record, and it's the combination of stocks rising and home prices rising that's driving net worth, household net worth above 150, well, it's 154, we're going to call it $155 trillion in America. How can this be happening? Now, I know how it can be happening, but when I watch CNBC and even Bloomberg, they're going to just look at the dark side. But I'm pointing to this and going, I don't know, it looks pretty good to me. I need to find out who that is, where they're spending, and put your money where they're spending. Because they're going to create more demand than supply. When there's more demand than supply, which way do prices go? They go up. And that's our job, is to find those places for you. So we're watching this kind of data. Now this, I almost didn't put this in here. So just look at the green and the red. I know you can barely read the text here. This is the same increase in household net worth that I showed you. You might be saying, well, but I bet their liabilities are increasing. So if you have a $2 increase in your net worth or in your assets and a $2 increase in your liabilities, has your net worth increased? It has not. But look at this since 2008. Look at the green rise here, but look at the almost steady liabilities. We're seeing a really amazing thing. Debt only grew by 2.7%, mortgage debt by only 2.8%. This is intriguing to me as a money manager because it says to me somehow, some way, either the data is lying, it's double sourced, Wall Street Journal and the financial accounts of the U.S., which is not a mainstream publication, is reporting this data. And this says to me people are not sitting around and doing nothing. They're working. They're increasing their net worth and not adding tons of debt on. That doesn't mean that there aren't people that are spending beyond their means. I need to find who these people are. I have a pretty good idea. And invest where they're spending. AI. Is it artificial intelligence? Is it anonymous intelligence? Is it annoying intelligence? I remember in 1993, a friend of mine came in and said, you got to see this. I said, well, what do I have to see? You have a modem? Yeah. So those of us that are old in this room, remember, you used to turn it on, you dial it, went, and then it would connect, right? Sorry for those that you have no idea what I'm doing. But so we did that, and he said, so you got to install this thing on your computer. It's called Netscape. We all, of course, know what that is. It's 1993. It's 30 years ago. And I sat there for 4 hours and said, this is going to change the world. And that's when I left a previous career of writing TV commercial music, and I became an internet developer for futures commodity firms. That's a whole other story. I won't bore you with that, but what's the point? Everybody thought that this was going to take down the world, right? Do you remember being scared of the internet? Maybe you weren't, but a lot of people were. This is where we are right now. So let's talk about artificial intelligence, the pros and the cons. So just 2 months after its launch, ChatGPT reached 100 million users. 2 months. No app has ever done that, including those apps that are naughty. Even more downloads than those. According to Bloomberg, AI is expected to grow to $1.3 trillion in less than a decade. That's the same sort of logarithmic growth that commerce on the internet went to. We're going to get this here. So I was really intrigued, but if I can get to this slide. So here are these models. These are not real people. Okay, this is a company who I didn't mention. They have decided to stop using models. They are going to use artificially generated women. Why? Because they want to be able to have the customer get the same tone of their skin, the same body shape, try out various colors. It's already pretty easy to try colors, but they don't fit like they would on you. So you can submit that data and then they generate an artificial person that looks just like you. I don't know about you, but these look pretty good to me. All right. So the CEO of the company says, we know our customers want to shop with models who look like them, and we believe our models should reflect our consumers. This is a game changer for this industry, and it is what they call a disruptor, a technological disruptor. I don't think this is going to happen everywhere, but I get the point of it. And the models will figure out something else to do, just like my grandfather was the highest paid guy in Fort Pierce, Florida when I was born. And he had been a telegraph operator since 1903. Not too many jobs for telegraph operators for like the last 75 years, right? But at the time, all right, so what is ChatGPT bad at? Well, it was pretty good at math in version 3.5, and then 4.0 came out, and there's a lot of data on the screen, but you can screenshot this when you get home if you want to really dig into this, or we can have a conversation. There's certain computations that it does in its earlier iteration than it does now. I know, I see Florian's face there. I'm just telling you, this is what we're hearing from Stanford. So this kind of unequal growing, where some things advance and some things are set back. I mean, you've all gotten your phones and gone, well, I like this new feature, but they took away this one. Why'd they do that? We all know how that works. This is what happens in early stage technology. I'm not concerned about it. This is particularly interesting to me. Apparently, ChatGPT, and one of my clients is a former guy at AT&T Labs. Actually, I got two clients that are former AT&T Labs. And he said this is the most interesting one to him because we can look at this and see, okay, we have a red block and a blue block. What enables them to move to the next panel? Well, you can see the other shapes are just similar, right? And so they move over. Same thing on the second screen. And on the third screen, the green little H on the side there moves over even though it's attached. Our eyes see that. Computer can't do this. It cannot go in and do this at the time of this writing. The visual recognition. So about 75% of the potential value from applied generative AI will come in these four business functions: customer operations, marketing and sales, software engineering, research and development. It's already changing these fields in a considerable way. And it's going to be logarithmic in the beginning. It's not going to be slow and subtle. And there'll be stops and starts exactly the way the internet was. I was ordering Christmas presents on Amazon in 1998, just 5 years after I had the experience with Netscape. And obviously it's changed a lot since then. So these generative AI algorithms, a generative means that, first of all, artificial intelligence is a summary of human data points. These computers don't assemble themselves, hit their own on button and start thinking. I'm sure you know that. We have to program them with ideas, history, iterations, etc., from human experience and knowledge. But generative AI is taking that input and creating something new, like those models. So it is generative AI, especially as they call it applied generative AI, that has most people scared. But guys, you can't put the genie in the bottle. So we own some AI companies. We've been stopped out of some AI companies, super volatile. But there will be some big, big winners. There is a Microsoft in there, and it's probably going to be a small company. It's not going to be NVIDIA. NVIDIA will have its share, but we need to find this for you and take very defined risk, which we'll get to in the last section. All right. So NVIDIA's chief scientist was actually interviewed by the Senate Judiciary Subcommittee, and he said, look, uncontrollable AI is science fiction. It's just not a reality. It's not. Humans will decide how much power to give AI models. AI computer-based models will never seize power by themselves. They have no arms and legs. They're not going to build themselves as a robot, at least not in our lifetimes. We've watched too much Star Trek with Data and Data's evil twin. Are you guys know who I'm talking about there? Okay. All right, so that's the reality. We'll cover more on AI as this evolves. The program turns too long if I spend 15 minutes on each segment here. And really the point tonight is for you to understand my thinking process in these areas. So the next 10, this is pretty much a brand new, because I want you guys to know what I'm thinking about in the next 10 days. So the earnings season's over. You saw on the screen, there's only one company left to report. Who are the winners? What do I see going into the fourth quarter? Does the technology sector still have to carry the ball? Or will technology share the love with the other 10 sectors? Technology is 27% of the US economy and 27%, roughly 26, 27 of the S&P 500. Who will or won't appear in the second Republican debate? Now, maybe that's just curiosity, but there's a power play thing going on. The person who didn't show up to the first one actually went up in the polls. They can duke that out however they want to do it, but I am following it. So what about the next 10 weeks? Remember, the next 10. Can the market hang tough to make it into fourth quarter with a little or no significant pullback? And I got tongue-tied because I really didn't want to have to say that after today in the NASDAQ. I mean, really? 15 years, those of you that have been coming here. How often has this happened? Wow. Can the S&P hit a lifetime high before 2024? Less likely. Or could it occur in the first quarter? I think so. The strongest 3 months of the year, November, December, January. And there's a reason for that. And I know by looking ahead at the questions, we have a viewer in New York, upstate New York, who had a question about that. I'm going to answer that, and you'll see where that comes in. So the next 10 months, India, I mentioned this earlier, really interested in India. India is now the most populous country in the world. And they are a pseudo-democracy. Modi would tell you that they're a democracy, but they don't really behave like a democracy. But they're a heck of a lot better than Russia and China. And we would be interested in partnering with them and providing military hardware and have them not get so much from Russia and China. Will that actually materialize, or is it a ruse? Because we will start to significantly invest in India with our clients. And I don't mean using ETFs on the New York Stock Exchange. We will go to Bombay and buy stocks there, okay, if it's right. And as we head into this 2024 election, will either of the two candidates or both be convicted of felonies and even imprisoned? I know it seems funny, but it is a real thing. There's a second next 10 months that I'm looking at, and that is Mexico. Look at this. Taking over China's role as our #1 import partner. Okay, I like seeing money stay on this continent. I am not a huge fan of Mexico and the way they've let the cartels just take over that country, but I'm very pro North America, and I am interested in investing. I can invest directly in Mexico City. I don't have to go around it as you would with Schwab or Fidelity, Interactive Brokers. I can invest anywhere in the world I want to, and I'm very interested in following that. And the next 10 years, the 10 biggest cities in the world, and Chicago at number 8, this intrigues me. It really intrigues me. I want to be here in 10 years to follow this, to see if we become a $1 trillion economy. New York and LA will do it. Tokyo will do it. But I think the people of Chicago, if they can get their act together, this would be wonderful to see that kind of growth. We're not there now. I see people laughing, but I've corroborated this from 2 sources. And I want to tell you that I'm going to be here. I'm either going to be here doing this with you in 10 years, or I won't be breathing. I approached the funeral home. I've already gotten my casket, and apparently I'm the first person to ever request a casket with a Bloomberg quote terminal in the casket. One of the reasons that I'm here, I've heard comments from several of you tonight about, gosh, you look thinner. Well, yes, I was a boat anchor 10 years ago. But there's a reason for that. And the reason is this guy right here in the front row. Raise your hand, Tommy. Tommy Else, my personal trainer for 5 years. Radically changed my diet. Radically working on building muscles. I get out of bed, guys, and I have never been more excited. about this because I see things like this and I want to be here when Chicago becomes a $1 trillion economy. And I want to be here with you. So everything we've talked about so far leads up to this module because there's really no point in all this. It's just a bunch of gee whiz data that you can get on the internet, except mostly it's not honest. This is. I'm gonna need a sip of water here. But our investment methodology takes the data points that I've shown you, puts them all together. Did you mute my mic? Sorry, that was quite a slurp. Another edit point, Patrick. And we invest. And we put your hard-earned dollars at work. Whether you're a client or not, if you don't know how your manager is doing this, you should. I already said that in the opening video. Is this the de facto way to invest? It is not. There are thousands of ways to successfully invest. What I have is a proven, systematic, teachable methodology, and I'm going to show it to you right now. So, investors love consistency. I think we would all be happy to have 1 plus 1 plus 1 plus 1 because that's generally more attractive. And there's a typo here, guys. 3 minus 2 plus 5 minus 7 plus 8. Is that what that last number is supposed to be? We would, most of us, just like to have consistency. How many of us would invest in CDs if we could get 18% for 20 years? I mean, why would we be in the market at all? And of course, that happened in the 80s. All right? Good traders have no attachment, no emotional attachment to a trade, and are happy to sell something that's not working. It took me a while to learn this and really, really, really never venture from it. When an asset gets stopped out, and there were several today, I take that money and I invest in something else. I don't look back. There's no sentimental. And the best performing stock of my career was stopped out today. Almost a $10,000 winner in the benchmark account. So not our whole net worth. And some of you that are in CG would have had a greater gain, some less, depending on the size of your account. But percentage-wise, you'll see when we get there. So this is the bedrock of sound risk management, limiting risk. Limiting risk is essential to sound money management. The problem is it's countercultural. So what is successful in this country in the real world? Not that trading isn't the real world, but it's, as I said, we're the ones in the straitjackets. If a football team wins 9 out of 10 games, they're doing great, even if they win by 1 point. Conversely, if a football team loses 9 games by 1 point and then wins 1 game by 100 points, they're still huge losers, right? But not so with trading. If you lose $1 on a trade 9 times and then make $50 on the one really crazy good stock, you're up $41. And obviously there's lots of zeros after this. That is emotionally counterintuitive. This is why people second guess those of us in the industry, because their emotions are screaming at them. I can't do this. I shouldn't do this. It's going to zero. Realize that this is what works for successful traders. Win ratios below 50%. You're going to see mine. Definitely below 50%. But the losses are small while their gains are large. And I'm going to show you actual trades in a way I've never done. And you can see this to a greater extent if you want to call me, meet with me. I'll send you the actual data that you see on the screen. The noise in the market rarely correlates to long-term significance. That's why you can't sit there in front of your screen and say, well, I'm going to watch, see what happens when non-farm payroll comes out, or when the unemployment report comes out, or when the CPI report comes out, and just react to it. You can't do that because your emotions are fighting. You go into every market day with a specific plan. And to avoid those catastrophic losses, you have to be able to lose on a regular basis. And in fact, you must be able to lose on many, many trades. And the next slide is the most important one that I'm going to show you tonight. It's not greater in that chart, but this is a slide with 3 words. It's going to feel very unnatural for you to read these 3 words, but I'm going to ask you to be open to it and embrace them, because this is how great traders and successful investors of theirs turn out. best loser wins. The best loser wins. We humans hate to lose. I love to lose. Because it means I have an idea that has told me it's no longer working, and it has freed capital to go on to a better idea that may work. And if that doesn't work, it's going to be gone too. As Kevin O'Leary on Shark Tank would say, just take it out behind the barn and shoot it. I married my wife. I date my stocks. It hasn't always been that way. Okay? You must separate your emotions. So now, from here to the end, not that long, I'm going to walk through the process. Let's say that I've studied my 10 segments, and I just got stopped out of a stock in CG. And I have stocks in the bullpen. So it's not baseball, something on deck, bullpen. But the research process starts here. There are 11 sectors in the U.S. economy. Where is the money flow going? I'm never going to compete with Goldman Sachs and JP Morgan. So where are the big players, the pension funds? You know that Yale has an endowment that's almost $100 billion. It's staggering. Where those players are going is where I need to go. But I can't just do it willy-nilly and coattail them. I need to understand the research. So right now, in this case, you can see money's going into technology and out of energy. This is flipped since this slide was drawn. All right. So once I have processed that, and you can barely see anything on the screen, and that's okay. Here's the column I want you to see. This is a list of stocks. How was this generated? It was generated by AI. Because I said, this is what I believe about unemployment. This is what I believe about inflation. This is what I believe about the chances of recession. This is what I believe about cross currencies, the strength of the euro versus the dollar, all these different parameters. Find me a stock that has done well. Don't guess, Mr. Program, that has done well in these conditions. And so it spews out these choices that then lets me go to the next step. This is the coolest program ever invented, Toggle. And it's several $1,000s a year to lease, but it is worth every penny. This is Adobe. And so what I was able to do is say, okay, I like Adobe based on all the previous segments, the fundamental. Understand those segments are fundamental data. Now we're talking technical data. You guys with me? What did Adobe do, Mr. Toggle, on a 6-month time frame when the Fed funds rate was under 4%, when they had 2 previous earnings that were stronger than reported? What are the chances of it being higher in 6 months? And in about 45 seconds, all this data comes on the screen with past history performance going back to 1995. This does not mean it'll be a winner, but what it does is gives me a leg up on other people that are still trying to analyze in a manual way. All right, this doesn't change the risk parameters. We get to that in the next screen. But when I do this on enough stocks, and you see 2 green lines here, I'm going to move in here because I can barely see it. The top 20% results for Adobe, 57% higher. The median was 16%. The worst case was down 2%. I like those odds. This time it could totally blow up. But that, in historical perspective, is what has not. So I buy the stock. Now, this channel, basically, the stock starts trading in this channel. And the blue lines all mean something. I don't want to get you off track on this. But basically, when it's hitting the upper edge, that's good. And when it touches any one of those blue lines on the bottom, see ya. The stops, they're called stops, the automatic sell orders that go into the market that morning. And if they're hit on a day like today, I don't look back, I don't second guess. All right, that's what happened here. You can see this stock was doing terrifically. This was that great stock I was telling you about, ELF. But it did get stopped out today. Whoops. This is actually cocoa. Nobody cares about cocoa futures, but it's a really cool looking chart. And you can see that I don't think my little red dot's working, so I'm gonna walk over here. I could have said right here, oh gosh, I think we ought to just stop out. I'm not gonna wait for the blue line. But then the next day, it's green. It's like, okay, well, what now? I'm just gonna pull the stop. It's gonna be fine. And then see what happens the next day. You can't. You can't do that. And these kinds of patterns happen on every kind of stock, every kind of commodity, every kind of currency. Why do they look so similar? Because they're traded by humans, and humans trade with emotions, and people hate to lose. And even worse, when they get a winner, if it's just a little bit, it's like, let's get out, so we have a winner. The best loser wins. Sell it, sell it, sell it until you find that winner. And here's how the data works. So the results from my trading platform feed into this reporting platform. Let's just look at some of this. I know it's a lot, guys, but it's so important. All right. So the return on winners, this is in CG and just the benchmark against 60 grand. Losers minus 41. Biggest loser minus 35. Biggest winner 88%. All right. Now, I limit risk to 1% on any stock. So then why does this say 35? 1% of portfolio risk. So if I'm buying a $5 stock, I don't care if it goes down 35%, as long as it doesn't hurt me more than 1% on my portfolio and your portfolio. What's my ratio of winners to losers? Look in the right-hand corner, lower right-hand corner, 2.5 to 1. That's a pretty good ratio. The very best hedge fund traders, in fact, the one under whom I've studied for the last year, Tom Basso. If you don't know about that, watch my CB3LIVE guys know this. You've seen those episodes. I interviewed him 3 times on the show. He's between 2.7 and 2.8, and he's been trading 50 years. But if we can get to those levels, then these are the kind of results we see. This is actual real time in your accounts. Number one winner just closed today. Look at the return numbers. I think you can see the column and the numbers. Now look at the biggest losses. Do you see the difference? Heads like this and heads like this. It's important. You guys get it? The winners are substantially larger than the losses. And how does this happen? Because I killed them when they started to sink. Wolf, my only loss of 2 grand. And it was a year ago. This is how you trade and make money in the markets. You make the decisions, you put the orders in, and you do it. What's the optimal size for a portfolio? This also is AI generated. So we know the market's volatile. I know you as investors would like it if I were less volatile than the general stock market. Certainly less volatile than the NASDAQ, right? How can I get there? I use AI to determine what's the optimal number of stocks at any given time to have in your portfolio and mine. We're getting a little late here, so I'm not going to spend more time on this, but just know that this is an important data point. All right? This is the actual performance on CG. We have a 12-year track record. The blue line is CG. What a great time that was. You guys were along for the ride in 2020, and then that downturn. I did not have optimal risk management in place. I was using risk management from 2002, 2008, but that has changed. And you guys know what it is now. And it's only getting better. I'm studying with some of the brightest minds in the industry. And they're sharing, and because I'm interviewing them. They like the free interviews. This is good for their publicity. If you haven't seen them, go to my site. This is what's happened in just this year. We had this downturn in March, but because of our stop process, we just kept closing in and closing in on the S&P. This is why I get out of bed. This is why I have 10 more years. The 15 that you see at the top, we started these in 2008. 8 plus 15 is 23. That's where we are. I just said earlier, I'm committing to go 10 more years because I'm so excited about this for all of us. This is a quote from Paul Tudor Jones. 85% of my net worth is in my own funds, primarily because I believe that's the safest place in the world for them to be. I believe it's going to be, I'm going to be so defensive and so conservative. This is a hedge fund guy talking, that I'm going to get my money back with an acceptable return. Hedge fund guy, not talking about how great a return, pie in the sky, all the images we think of. They're just trying to be conservative and get their money back. But he's worth $8.3 billion. And all I can say to that is ditto, except I'm worth a whole lot less. Risk control is and will always be the absolute bedrock of our trading methodology. And the really exciting thing is, as opposed to 10 years ago, our methodology is now fully systematized. What do you guys know about systematizing? You can, if you know how to make a hamburger at one McDonald's, you know how to make it everywhere. We can teach a junior Parker how to do this. I'm interviewing 5 right now. I hope to introduce that person to you in January. That doesn't mean I'm going anywhere. I always joke about Warren Buffett, who at age 75 said it's probably time to pick a successor. That successor has been looking at his watch for 18 years because Buffett's still 93. His partner, Charlie Munger's 99 and still running the show. And Berkshire just hit lifetime highs. So what do you say to that? Okay. You guys remember what we did here? Very, very briefly. Monthly market review. September. Worst month of the year. We'll get over it. U.S. policy. Red, blue, doesn't matter. There's good and bad. Don't get caught up thinking it's got to be one way or the other. The Fed, I don't know what to tell you. They're going to figure it out sooner or later and get a clue. We're following them. Inflation, it's coming down. We like down lines for inflation. Recession, not seeing any data that supports it. U.S. housing market, surprisingly resilient. Please tell Diana I was thinking about her because I think it's the bellwether for the U.S. economy. Employment scenario, again, mixed data, but overall positive. The economic indicators, some juxtaposition going on, but still positive. AI, it's here, guys. Can't put the genie back in the bottle. It's going to be real interesting. Let's enjoy the ride. The next 10 days, weeks, months, years. We'll be there. We'll be talking about them together. And then our methodology, taking all of that and creating a trading plan for your accounts. That is what we do. And as I said, for the first 12 years, and now it's your turn. It's your turn. Questions, anyone? Him.
Food and energy.
So I'm going to repeat questions just so you can hear it. So, you know what? Probably just to keep the Mark. Let's keep the mic on Alice, and I'll just repeat the questions because we just got the one mic, right? So, Ken's question is, why are there two? There's core CPI, and then excluding food and energy. Food and energy are very volatile. Well, they're still really important. I wish that there were not two data. If you see data that you don't like, then create a different data stream if you're a government employee or a government house. That's exactly what's happening. We're going to sculpt the data until we can make it work. Because energy and food, and if you add on medical treatment to that, those are what we care about. Because that's the biggest percentage of risk. If shoes go from $85 to $88, I don't care about that. Gasoline from $4.20 to $5.05, that matters. Good question. Thank you. Alice, what do we got on CB3 Live? Who do we have?
Andre, I have Andre from upstate New York who wrote in and asked, is there any credence to this? I see that many fund managers invest typically 2 times a month, end of the month and middle of the month, typically resulting in a boost, even if temporary, to the market in general.
And that's true. That's absolutely true, Andre. Good question. Here's why it happens. Because when you are working and you're contributing to a 401k, you're probably getting paid 24 times a year, which means twice a month, or 26 times a year if you're getting paid every 2 weeks. And during those times, if you are debiting your paycheck to go into retirement savings, it's going into a mutual fund or a sub-account in a 401k somewhere. And the SEC does not let them hold that in cash and try to time the market. Because they could sit there for a year and you go back and it's like, hey, the market's up 30%. You haven't done anything. Yeah, well, we were trying to time it. You can't do that. So that is why we had those bumps. Now, why are November and December the strongest months of the year? Andre, same reason, because that's when makeup contributions go into 401ks or profit sharing, other tax deferred vehicles for companies. And they're just getting slammed in there in November and December. Now, can the market go up as well? Yes, but buying begets buying. Great question. Go back to the Fireside chat audience. Anybody? Question?
I'll pitch it.
Ken? All right.
AI investments, are your investments for silicone, for software, or toward the hardware and data center construction?
Great question. So AI, just like the internet, 30 years ago, and even now, you can play a play in many different ways. It could be hardware, software. It could be in the, like if you were in energy, you'd be upstream, midstream, downstream. It's too young. We're looking anywhere. We're looking anywhere right now, but we're especially interested in disruptors. The company that's doing this with these models, and I feel bad for the models, I really do, but there will be something else for them to do. This is a huge win for people that are wanting to try on a coat, and they may not want to go into a store because they're a little heavy or whatever. All right, but they can do it online, and it's exactly the way they look. So those kinds of generative AI opportunities are what we're looking for. You got a second one from CB3LIVE?
A lot of them, actually.
Okay.
Deb
You
from
guys
South
gotta come on.
Florida asked, how do you feel about credit cards being used to pay for most purchases instead of cash? Do you think our cash will become useless, so all purchases will be tracked?
So this sounds like a privacy question more than it is the dollar stable question. For years, people have used cash. I don't think that that's going away too soon, but within 50 years, we will be a cashless society. There's no question. The real question or concern is the U.S. going to be the reserve currency until we're dead, all of us? We have a huge advantage with the world's most important commodities, among them crude oil, priced in U.S. dollars. Okay. I realize that's a little different than what you asked, Deb. If you're watching, thank you for the question. But yes, I think we're heading in that direction. The anonymity part of what you ask, attempting to be realized with Bitcoin and Ether and those currencies, but they have just been flat for years now. So we'll see. We'll be watching it. John. Sure.
Where's that going? There's a lot of talk about like digitizing, currency like the dollars and all that.
Sure. So John's question is really twofold. It's the established speculative currencies, Bitcoin, Ether, et cetera, versus governments saying we're going to digitize our currency and do away with paper money and coins. Those are on the same track to be developed together. One is a replacement vehicle, the ones issued by governments, and the other is a speculative. And as a speculative tool, Bitcoin has been a huge flop, at least for the past couple of years. The problem with countries digitizing is people just don't trust their countries. Now, you guys trust the United States. I realize it's totally unblemished on that, but there are countries in the world that, but I digress. Answer your question pretty much. Alice, go ahead.
I have another one from Nellie in Georgia. Actually, it's two questions. What AI company do you see as having the best potential? One, and two, what are your thoughts about cryptocurrency?
Crypto again. Well, so let me start with the second one, because we just talked about them, and I'm piggybacking on what John asked. We still trade crypto. We don't own cash cryptos. None of our clients do. We trade crypto futures for those clients that are in spec op, which I will say today closed up on the day. We beat the S&P by 310 basis points, but that came from being short the Australian dollar, British pound, and some other crazy investments, cocoa. We'll talk more about that in January, not right now. All right. So I have no interest in cash cryptos right now. I want assets that trade on an exchange, because we've seen in the past several years, crypto exchange is crumbling, right? And being defrauded. And there's always the case where, somebody lost a key and you got $2 million on this key because people say, well, I don't want to keep it on the exchange because it's going to be stolen, so I'm going to put it on this little hardware device. That's crazy. That's just a different flavor of putting it under your mattress, right? Go ahead.
The second question is, what AI company do you see as having this potential?
I don't know. We're looking at the big guys, NVIDIA, obviously. We've been in for a long time, done great on NVIDIA. We had AI, the actual company, AI-C3, which started out like 14% on the first day, or maybe it was the first 2 days we had it, and then it ended up being a loser. It's just too new. I have a client who loves IPOs. We got to get into ARM. We got to get into ARM. So don't do that. Don't do that. You guys followed ARM? This chip company? It's below the IPO in 4 days. If we were all 30 in this room, it'd be a different mindset. I mean, there's something about, I want to see you have the highest risk-adjusted returns possible. And it has to be risk-adjusted, meaning we can't just go crazy and buy crude oil futures unhedged. We want great returns, but we're using a methodology like this. And if you're not with me, you got to have somebody that can explain that to you on TV. You've got to have that. You don't need to know how we do what we do, but you need to know what we do. You got one more?
Greg from somewhere along the Alaskan coast asks, I live very remotely on a 65-foot boat and travel the inside passage through the summertime. So tell me, how can I stay in touch with you on an as-needed basis? I have a satellite phone, but I'm 3 hours behind you.
Well, first of all, Greg, thank you for being a viewer in yet a different time zone. I think that brings us to 6 time zones, Alaska. That's why we have digital media. We're on social media. You can obviously call me, Greg. I'd love to talk to you. I'd love to just hear about somebody living on a boat. So anyway, we'll stay in touch. Brian, go ahead.
What's your opinion on the integrity of China? Chinese.
Oh, gosh.
Why bother investing there?
Because I've got stocks that are up 32%.
Is that real?
Well, it's real because it's traded at Interactive Brokers, and they have people on the ground in Shanghai, and nobody's taken the positions out of my account. So it's a U.S. company doing business with trading permissions on the Shanghai exchange. The best performance we have, not to be my ones here, but we've got 5 killer winners in Tokyo. Now, without poking fun at any other broker dealers that don't have access to international markets, that are using ETFs and they're using currency hedging. We don't want currency hedging. I want to enjoy the differential between dollar yen or euro dollar or Aussie yen. So I go to those countries, and those of you that are with me in Interactive Brokers can do that. So do I trust them? No. Am I prepared to take out my money at a moment's notice? I am. Okay.
So I was listening to Solomon's interview. Conference. And he has been talking about the investment in Saudi Arabia as a huge portfolio for the kingdom. So my question would be, will CB3 be involved with any of that investment, or is that going to be just within the kingdom investment?
So that's real interesting. Riyadh is the capital of Saudi Arabia, and they're actually the only stock market in the world that's open on Saturday. There's your trivia question for the night. When I had a Bloomberg terminal, I would log in and say, I'm working on Saturday. I can watch the opening ticks of the Riyadh market. They're very inward focused. You're probably aware that Saudi Arabia is trying to buy up sports entities and get these stars from all over the world. It's a free world. They can do that. I'm interested any place on the planet that there are opportunities. And Interactive Brokers trades it at Riyadh Exchange. So I can. Not as interested there as I am in Bombay as a new market. Love Tokyo. Love Shanghai. I don't love Shanghai. I like Shanghai. What was Brian that was saying that? I don't trust China as far as I can throw them.
But I thought before Saudi Arabia, not for, and I think that's what they should.
Well, they're nationalistic, but when we're nationalistic here, then everybody gets upset, and then don't get me started on that, because then I'll get political. I don't want to do that. But nationalism, a certain dose of it is healthy. Jeff.
With what they're asking for to the union, what do you see happening to automobiles besides going up in price? But what do you see happening as far as the economy goes?
So I stand up here and say my ability to react is more important than my ability to predict. I need to react and react quickly. I don't know how this plays out because you saw the map. I mean, this is kind of like, I hate to use, sniper, but they just went in and strike, different strategic places. They're very organized and they want what they want. Is it going to hurt the economy? Absolutely. If it stays in place much longer. Will this cause domestic car prices to go up? Only so much, because the Asians are waiting right there. Don't you think the market, they'll equal the dollar spent in marketing and we'll lose market share? They need to give up those pensions. Again, I should not be offering opinions on this because they can't afford them. These legacy companies can't afford them. And when I buy a new American car, if I do, I don't want to pay for pensions. I don't get a benefit of that. Sorry, I feel very strongly about this, and I shouldn't be doing that in this medium, but you brought it out of me, Jeff.
But isn't the real question how they're going to embolden the rest of the unions? Whether they're successful in tying pay increases,
Sure.
CEO pay, and everything else, or all the other unions will follow suit.
That's what they're hoping.
There goes your inflation.
Exactly. So that's why it's so important that we're following this. So Ken's saying, is it going to embolden other unions? We'll see. We'll see. You have one more, Alice? I know.
From Don in Glendive, Montana. Has the move back to Chicago from beautiful southern Nashville been worth it? What do you miss the most about Tennessee?
Okay. Real estate prices. Love the culture. Love the people. Love the barbecue. Love the topography. Here's what I don't miss. The summers, you feel like you're walking on the surface of Venus. Number two, at Nashville International Airport, they have runways for the dragonflies. Huge. And the farm that was out in back of our property, 4-inch rattlesnakes. More venom than a Liz Cheney press conference. Yuck. I'm glad to be here. Thanks for your question, Don. Keith.
I was going to ask you about your CMT certificate.
I wish. I understand you did. It's 2.5 years of study. So, I guess it could be equivalent to a master's degree. I appreciate you asking. It's just a different study. 50 years ago, they realized, well, we have these other certifications. CFAs have been out there forever, CPAs, CFP, relatively new. But what really trains people to trade the markets? And to do so in real time, in high pressure situations. And so that's what this is all about. When I made the decision in my mid-60s, it was real strange going into the Sylvan testing centers, and everybody looked at me like, oh, this guy's grandfather's taking his test for him. But you're never too old to learn. So have to take continuing ed like other disciplines. But thanks for asking. I love it. John. Yeah, and I'm going to get to that, Patrick. What about breakdown time? Are you going to be okay? Or Okay. India. I didn't get back to that, but go ahead. What's your specific question?
You know, me being kind of involved in IT, right? Like when we had all technology outsourcing, offshoring, India became like the biggest
Sure.
economy. And then now you say like you're interested in India. Is there anything else in India that you see like, okay, now I'm gonna go in there, or you've always been there?
I tracked it. I haven't, as far as third world markets, I've really only invested in, they wouldn't like to be called third world, but they are. They just happen to be the biggest country in the world. The problem is stability. It's political stability. That's why I say they're purported democracy. You know, it's different than investing in England or France. Now, they're not even true democracies too, but they at least don't think that they're going to implode. I don't want to go to a place where the currency could drop 15% overnight because the government just marches into the capital and takes over. I don't see that happening in India. But it's their partnership with the US to supplant, to replace Russia and China on the munitions, the military munitions, that really has me most interested right now. So, one more, CB3 Live.
Actually, I'll do this one. This one's from Charles in Florida. CB3, what's your thoughts regarding the debt market sell-off intensifies? Stock market risk is skyrocketing. And are you short in the market at this time?
So I know this guy. How are you, Charles? Thanks for watching the show. I am not as dire on the markets and America as you are. All right. So am I short in the market? Spec Op is short right now. But it's not appropriate for almost all of our investors. We have very high net worth investors that do trade that. I'll talk more about that in January. Right, I promise. Go ahead. Did I answer the whole question? I guess.
Yeah. This is from Jay in Ohio. How are the higher interest rates affecting housing prices?
Well, you saw in the real estate section, people are still buying. Dumbfounds me that we're having bidding wars. And these aren't necessarily in $5 million homes, which are typically the ones that they write a check for. But these are $600,000 to $800,000 homes, which are going to have a mortgage, which are going to go at 7 3/4. But they're just not writing off. They're ignoring the requirements. They're bypassing and saying, we don't care about the inspection. We don't care about even being qualified. If the bank turns us down, we'll take the risk. We'll take it out of our accounts and pay for it. And that's because demand is still so strong. Okay. I think if that's it, guys, I cannot tell you how happy I am that you are here for the first one in 3.5 years. We will see you in January. So I always, on CB3 Live, I end with this: for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. Never discount the power of the good book wherever you are in your faith walk. It definitely makes a difference to us. I hope it does to you. We will see you in January, CB3 Live. We will see you next month. You guys can watch next month online too. God bless you all. Bye-bye. Thank you.